It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man himself, smartest guy in the room, Mr. Michael Becker.
Hey, Paul.
How are you?
Doing well.
It is a beautiful day outside, and I'm sure you are about to close another transaction.
Maybe. trying to. We were perpetually in escrow for about 2-year period there, so we're trying to keep our streak going. Sometimes it's a little hard. We're in escrow now, so hopefully we'll keep the trend going. And
Is the sun a little brighter? Is the grass a little greener? Is the wind a little nicer to your skin when you're in the middle of an escrow?
Yes and no. It makes me feel like I'm doing my job better, but then it's always a million little moving parts that you got to kind of juggle, especially when you have multiple of them going at the same time.
Now, you guys are, $650 million under asset management?
Something like that, yeah.
Over $1 billion in closed transactions?
Yeah, I've been a principal in over $1 billion in transactions.
Raised over $200 million in equity?
So it's going to start adding up here at some point, right?
How do you sleep at night, my friend?
Like a baby.
So, Michael, as you know, is a former banker for a large regional national bank. I made the transition over a couple of years ago from being a loaner of money to an owner of real estate. So we appreciate some of the input that Mike has and kind of talks a little bit about what's going on in the industry, the economy, the operations of the properties. He is the man.
Before we get into that, Paul, what's going on in the Old Capital world? Is there anything to pay attention to?
October 25th, do not forget the Old Capital Multifamily Conference in Dallas, Texas. If you have been to our conferences before, it's an all-day event. It's going to be at the House of Blues. We've rented out the entire House of Blues. We are going to bring in some excellent speakers for you to listen to, take some notes on. But the biggest thing is network. We want you to network with other principals, other limited partners, investors, other people that are
brokers.
Are experts in whether they're attorneys or brokers or educators or mentors or somebody, that goes around the industry that you want to know. That, this is to open it up for you to get to know them as best that you can. So October 25th, go to the oldcapitalpodcast.com website, oldcapitalpodcast.com website. We'd love to see you there. So reserve your ticket now.
Who's going to be speaking there? We don't have a keynote there, but who else will be speaking there?
We're not going to disclose who the keynote speaker is. As you know, last year was Roger Staubach. The year before, it was Rob O'Neill. This year, we're excited to not announce it, but we'll announce the next 2 months or so. So look for that.
Do you have any economists speaking there, Paul?
We have the chief economist for Fannie Mae that's going to come in. So she's going to give a great background about the national economy. But probably the guy that you really want to come talk to, because this is kind of a key to the question today, is Greg Willett is going to be speaking at the event. And Michael, you went to go listen to Greg Willett speak back about a couple weeks ago. I heard him a couple weeks ago over at a conference that we did up in San Jose with J.C. Castillo and Brad Sumrock and Dante Andrade up in Northern California at the Apartment Investor Network that we belong to. And we also had Greg Willett on our podcast about a month and a half ago. So I want to get some of your takeaways of what you heard. The man himself, Greg Willett from RealPage, what did he say? What brought you into what he was talking about?
Yeah, so the event I was at was a ULI event, and it was more Texas specific. So it was kind of an invitational thing that one of the major apartment brokers here put on. And so it was a lot of big time developers and apartment owners and the attendants. So, people like Lucy Billingsley, who develops, thousands and thousands of units. She was there. So he was a little bit more Texas centric. And then Paul, I think you're a little more national. So I'll kind of talk a little bit about some of my key takeaways. And so really a lot of what the developers that are in that room, that develop in all the major metros in Texas. So he does a lot of the comparing and contrasting of the 4 major metropolitan markets. But really kind of my first key takeaway was, as far as like occupancy goes, Texas is surging and Houston is falling. So really it seems like, a few years ago, Austin had a lot of supply and they got a little soft in occupancy, and that supply is kind of pulled back now. And so it seems like there's about a 70 basis point positive change year over year for the first quarter in occupancy. So occupancy was up about 70 basis points. Well, Houston's the opposite of that. So Houston had a ton of supply, and then they had the oil bust, and it got real soft, and then all of a sudden overnight they had a big surge in leasing when Hurricane Harvey hit. So all these people got displaced from their homes, moved into multifamily. And then everyone thought that Houston's occupancy problems were over. Well, it seems like the Harvey surge is rescinded. So the storm surge went in and it's now coming back out. So I think that about 140 basis point decline in occupancy in Houston. So a lot of that is these displaced homes got put back online and people moving out of apartments back into their residence. So it seems like Austin's doing better. Houston's starting to struggle a little bit more. And then Dallas, Fort Worth, and San Antonio kind of in the middle of those two. Also seems like Class A rents are having a comeback. So it seems like the nationwide that the Class A rents have had big occupancy or rental rate growth issues, just because they have so much new supply, that Class C and Class B were materially outperforming them in rental rates. It seems like that's kind of normalized. So it seems like Class C rents are kind of tapering off. Class A is coming up, and it really seems like it's pretty consistent across all property grades, A, B, and C, the rental rate growth kind of across the board. That was another takeaway. Seems like in Texas, really the Fort Worth side of the Dallas metropolitan area and the Austin markets are kind of neck and neck as far as performance of being the best two performers. Dallas still has a lot more supply. So, Dallas Fort Worth is, about 7.6 million people, something in that kind of general range. And it's about 1/3 of those people live on the Fort Worth side. About 2/3 live on the Dallas side. Well, the supply is about 80% on the Dallas side and 20% on the Fort Worth side. So I think you're seeing a definite divergence in performance. And the Fort Worth is outperforming Dallas as a whole. So I think that's been a consistent theme, he said, for many years. And that's, we kind of feel that in our portfolio as well. So that's still the case. And then Austin's right there with Fort Worth. And then as far as, my final kind of takeaway to kind of that point is that he's projecting of all the major metropolitan areas in 2020, that Fort Worth will be the leader in rental rate growth for all the MSAs across the entire country. So I thought that was kind of interesting. All these high flying markets, and Greg Willett's prediction for 2020 is Fort Worth to be the leader in the nation in rental rate growth, about 3.7%. And he mentioned that in 2020, their base case economic scenario is a recession. So he doesn't think it's necessarily like the last recession we went through, but there is a base case for a recession in 2020. So, Paul, what was some of your takeaways as well?
So, again, Greg Willett is with RealPage. He's their chief economist. We had him up in Northern California, a week and a half ago, 2 weeks ago. Michael saw his presentation down in Dallas. So his comments were really on a Dallas-Fort Worth, Texas economy piece. Mine are going to be a little bit more about what Greg's talking about on a national piece. What's good about Greg is that RealPage is a technology company, and they're almost like they have a reservation system, like a hotel. They have the information that comes in from somebody that wants to lease an apartment building, so they know exactly when that lease starts, when it ends, what the operating statements look like for every individual, and they monitor 14 million apartment units throughout the United States. 14 million apartment units throughout the United States. So they have some up-to-date current data as of last night. So we put a lot of faith and trust into RealPage. And then also too, what Greg did is that he did a Facebook Live podcast with us. Facebook Live, something to take a look at. We'll put that on Old Capital Podcast so you can kind of download that and kind of listen to some of the questions that came up. But his takeaway really is that apartment demand is still robust and the absorption should remain strong. But they do expect a brief interruption across the board, across the United States, sometime of a slowdown at some point soon. He was more likely thinking that it was going to come in the 2021, somewhere in that time. That's not falling off the edge of the cliff, but it's saying that we're going to have a slowdown. We've had this huge economic expansion for so many years that sometime it's going to slow down. Some of the things that he pointed out, which I think were interesting, that home ownership rate has moved a bit above its 2016 lows. So remember back in 2008, I think we were up at about 68, 69% home ownership rate in the country. I think it fell to probably about 63, 64, somewhere in there. Now we're up at about 64.2%. So I think a lot of people are still thinking as apartments is the way to live their lives. I think they saw maybe their uncle or their aunt or their parents that lost their house probably in the Great Recession in, say, 2008 to 2012. And a lot of people want to still stay in apartments. And then we also have people that have always lived in apartments that don't want to leave itself. And so one of the things that they also talked about is that we're going to, throughout the United States, we're almost going to have 400,000 apartments, market rate apartments are being constructed in the 150 largest metros in the United States. So we got a lot of apartments still to be built. In fact, we have about 37,000 apartments being built just in Dallas-Fort Worth itself. So we have a lot of apartments.
And that's by far the most in the entire country. Right? That's the next major metro.
Second one is Washington, D.C., about 19,573. Los Angeles, about 15,794. So
almost double the next closest competitor. But with that also comes demand, right? Because we have so many people moving here, so many jobs. So we need to do that to kind of keep up with the demand and the future demand, right?
Well, everybody thinks that's because we're just building so many units that we're going to have occupancy problems, but we're going to have tight occupancy. So it's going to provide evidence of no overbuilding, except in a few individual neighborhoods. Because right now across the United States in A, B, and C properties, in the first quarter of 19, we were at 95.2% occupied, 95.2. I can't imagine that's going to be anything higher than that. I mean, that's pretty good. So I would imagine that we're going to continue to see rents climb. I don't think we're going to see the rents climb as high annualized from what it was of last, say, 7-8 years ago, but really climbing on an annualization of 3.3, and that's what's being projected right now for the first quarter of 2019, 3.3 rental growth. Are you starting to see that in some of your units?
Yeah, like I said, I think what generally is happening is the A was lagging and the workforce was higher for the last 4 or 5 years, and now the A has kind of come up, and the workforce is kind of moderated just because they're starting to hit affordability issues and stuff in their tenants.
Yeah, for the last 35 quarters, the average has been about 3.7% rental growth on a quarterly basis. Now we're at 3.3. That's still pretty strong, I would imagine. So rental growth as an average is about 3.3, but if we break it down into different sectors, we have a kind of a preponderance of more Class B buildings. That's about 3.4. Class C's are about 3.1, and the same as Class A buildings at 3.1% of rental growth. So still great. Areas, just like Michael says, Houston area is going to kind of maybe a little bit more troubling. They are the king of concessions throughout the United States. They're offering sometimes up to 36% of their inventory are offering concessions. So that's not good. Areas that I think Michael mentioned, but on a national level, rent growth paces have been outstanding in some of these great areas like Austin, 500 basis points greater year-over-year rent growth. Phoenix, 360 basis points. Memphis, 320 basis points. Atlanta, 250 basis points above. This is above what you're getting in rental growth. So Nashville, 220. So you get some of these metro areas that have just done fantastic. So we want to continue to keep rental growth going up. In some of these smaller markets, whether it's Midland, Odessa at 15.3%.
It's unbelievable.
Yeah, but because Midland, Odessa is so impacted by oil prices, when the oil prices go down, they're not going to be up by 15.3, but they may be down by 30.3.
You know, it's funny. You could buy like a B-class deal in Midland, Odessa for like 180,000 unit, and a similar deal in the Dallas-Fort Worth area may be 110 in a unit, but you would buy a deal in Dallas-Fort Worth at a 5 cap, and the deal in Midland, Odessa would be like a 7 cap. And so you're paying 70,000 more unit, and you're getting 200 basis point higher cap rate, but then that can certainly swing against you super quick as well. So real volatile market. Yeah,
there's lots of capital chasing a limited amount of deals, so sales prices have climbed. In I think 2019, we had $202 billion in transactions trade in 2018. So 2019, we're still seeing the same pace. Our average cap rate across the board is about 5.5. And our average sales price, whether it's A, B, or C, is about $161,000 a door.
That's nationwide, right?
That's nationwide. So areas like Dallas, it's about 135. Chicago, about 193. Our friends out in the Bay Area, 446.
So I think that's also good to put in perspective because we're so Texas-centric and, people... I as a banker, I'd see all these people with California math coming to Texas back, 12 years ago and get their clock clean. But if you go back, what was the spread between, say, Dallas and Chicago? Because, Dallas is on pace to overtake Chicago in population in the next, 15 to 20 years.
193 versus 135.
So you see on a relative basis that you get, $60,000 more expensive product in a declining economic area like Chicago relative to, a booming area like Dallas-Fort Worth.
Could buy something up in Detroit for $58,000.
Yeah, and then Detroit peaked in population, like 1960, and it's got cut by 75% or something like that over the last 50 years. So, Chicago's the next Detroit, I think. And Dallas was the next LA from the 1970s is kind of what it feels like right now. And it's just happening before us, slowly, day by day. And there's still I think people always get a sense of like, hey, is everything overpriced, everything overheated? But just that's a good little metric right there, just as a gut check that, it's still 60,000 on average below what Dallas-Fort Worth is to what Chicago is. So, every deal's, specific. You got to be careful about where you buy, what you pay, how you operate, all that stuff. But the macro trend is I don't see what's stopping Dallas-Fort Worth and I don't see what's stopping the Texas story. We have phenomenal demographics and, relative to a lot of other places, we're still cheap.
Yeah, I stole all that information from Greg Willett. So that's kind of the presentation that he did for our group up in Northern California on May the 9th. And so go to Look Apple Podcast, download that Facebook Live feed, and then you should be able to get the slide deck on that so you can put your name on it and look like the smartest guy in the room too. So some great information that has come out of Greg Willett, and we do appreciate him being on our podcast and being part of our team to kind of explain what's going on in a macro and a micro scale. Talking about that, Michael, what's going on at SPI World?
Really, if people want to find out more information about us or potentially working with us, the easiest way is just go to a company's website, which is www.spiadvisor.com. That's SPI like spy, advisor.com. There's a contact us form, fill it out. I'm always happy to have a 10 to 15 minute telephone call with listeners off the podcast. We have many people that have reached out and invested with us, so I definitely appreciate everyone that's taken the time and committed capital with us. We take that real seriously, and we try to do our best to work real hard and make everything successful and deal. We're in a business of problems, and every day there's problems, and that's what we get paid the big bucks to go out and solve a bunch of problems.
So that's great. Again, Michael Becker, smartest guy in the room. I'm Paul Peebles. Have a great day.